This video was brought to you by Brilliant, and the first 200 people to sign up using the link below will get 20% off an annual premium subscription.
Over the last month, there's been a slew of bad economic news for the UK. Inflation is at a 40-year high, GDP is shrinking, and the OECD now expects the UK to grow at the slowest pace in the G20 apart from Russia. The pound has slid 15% against the dollar in the last year, and the Bank of America even warned that the pound was looking like an emerging market currency. So in this video, we're going to be taking a look at the state of the UK economy, why it's in such bad nick, and what the government can do to sort it out. As we see it, there are two distinct but related problems facing the UK economy: low growth and high inflation. Let's start with growth. Now, if you live in the UK, this might sound a bit weird. You probably remember Johnson and his government repeatedly bragging that the UK has the highest growth in the G7. That sounds pretty good, right? Well, while it's true that the UK had the highest growth in the G7 in 2021, this is largely because the UK had the worst contraction in 2020. For context, according to the IMF, the UK economy grew by 7.4% in 2021, higher than any other G7 country. However, it also contracted by 9.3% in 2020, the worst contraction for any G7 country. If we calculate combined growth for both 2020 and 2021, then the UK doesn't look so good, coming in at 5th place, above just Japan and Italy. Things don't look likely to improve either. In April, the IMF forecast UK growth to slow to just 1.2% by 2023, the lowest in the G7. Last week, the OECD released an even more pessimistic forecast, which had UK growth at 0% for 2023. The lowest not just in the G7, but the G20, with the obvious exception of Russia. If the OECD is correct, then the UK will have not just the worst growth in 2023, but the worst cumulative growth since 2019 of all the G7 countries. And its long-range forecast, which runs from 2020 to 2027, expects the UK to catch up with the rest of the EU from 2023 onwards. And if that wasn't bad enough, in the last couple of months, the UK has done even worse than analysts expected. In March, the ONS announced that UK GDP shrank by 0.1%, below the 0% that markets had priced in. And in April, UK GDP shrank by another 0.3%, well below the 0.1% increase expected. Worryingly, only London and Northern Ireland have seen positive growth compared to their pre-pandemic highs. The economy now looks unlikely to meet the Bank of England's expectations of 0.1% growth in the second quarter of 2022, and is on track to perform even worse than the OECD's predictions. So why is this? Why is UK growth so weak? Well, let's start by explaining what GDP actually is. GDP is calculated by adding together consumption, investment, government spending, and net exports. If any of those go down, then GDP goes up. Now, the UK has a couple of structural drags on GDP. For starters, the UK has a serious productivity problem. Productivity basically measures economic output per hour worked, and it's pretty much the most important metric in economics. If your GDP is growing but your productivity isn't, then that just means you've either got more people or you're working more hours. Nobel Prize-winning economist Paul Krugman once said that productivity isn't everything, but in the long run, it's almost everything. Since 2008, most of the developed world has seen productivity slow significantly, but the UK has been particularly badly affected. From 2010 until 2019, the UK had the third lowest productivity in the G20, ahead of just Italy and Greece, which is astonishing given that, from 2000 until 2007, the UK actually had one of the highest productivity growths in the G20, behind just Greece, Finland, Sweden and the US. This has probably partly contributed to the UK's appalling wage growth. Real wages, i.e. wages adjusted for inflation, only returned to their pre-2008 peak in 2020, And the UK saw the weakest wage growth in the G7 from 2007 until the pandemic. Low wages reduce GDP, because low wages mean lower consumption, which is one of the 4 components of GDP. But perhaps the single largest drag on GDP has to be Brexit. Brexit has significantly increased trade frictions, thereby decreasing the UK's exports. As you can see from this graph, since the Brexit deal came into force in late 2020, the UK's goods exports have lagged significantly, behind the rest of the G7, which has again hurt GDP. Similarly, since the referendum in 2016, investment has fallen off a cliff, presumably due to Brexit-related economic uncertainty, which discourages investment and thereby reduces GDP. Doppelganger analysis by the Centre for European Reform, which basically involves using data from other similar economies to simulate the UK's economic performance without Brexit, has found that Brexit has reduced GDP growth by an astonishing 5.2% since 2016, or about 1% each year. Now, we should take this analysis with a pinch of salt. No simulation is perfect after all, and the UK's response to COVID will skew the data. But it's nonetheless clear that since 2016, the UK economy has underperformed. You can get a sense of this by just comparing the UK's performance with other similar advanced economies, which have grown significantly faster on average. Anyway, you get the idea. UK growth is lagging, and the data suggests it's largely because of Brexit. It's a similar story with inflation. The UK is looking at one of the highest inflation rates in Europe, with the most recent ONS data putting year-on-year CPI from April at 9%. Again, forecasts are gloomy. The Bank of England is warning that inflation might yet hit 10%, and analysis by the Financial Times suggests that the UK will have the highest inflation in the G7 through to 2024. Why is inflation so high? Well, it's partly because of the weakness of the pound, which is down 15% against the dollar year on year. This makes imports more expensive, pushing up prices. Both the Bank of America and Deutsche Bank have recently warned that the pound is looking more and more like an emerging market currency, citing the fact that traders are increasingly taking short positions against the currency, i.e. betting against it, and the impacts of Brexit, which have limited the Bank of England's monetary ability. Brexit has also introduced more friction into supply chains, pushing up the cost of imports. Doppelganger analysis by Catherine Mann at the Bank of England found that Brexit has pushed inflation up by about 5%. All in all, the UK economy is in a pretty terrible state, and according to the data, it's largely due to Brexit. Fixing all this will probably be extremely difficult, which is why the Conservatives' internal squabbling is so poorly timed. The challenges facing the country are enormous, and they need more political attention than they're currently receiving.
Brilliant is an online STEM learning platform that teaches you everything you need to know to better understand the modern world. Baffled by investment and finance? Well, they've got courses on maths and quantitative finance. Confused by coding? Well, they've got everything from the very basics right through to quantum computing. Unclear why you're losing millions? Well, there's no guarantee that Brilliant can help with that, but they do have courses on cryptocurrency and gambling. You get the point. Everything you want to learn about STEM is covered by Brilliant. And the best thing is that all of their courses are designed by award-winning instructors and built upon the principle of active learning. So you're gaining STEM knowledge by actually doing it. So if you want to improve with STEM, then you can sign up to Brilliant at brilliant.org/TLDR UK. And the first 200 people to do so will get 20% off an annual premium subscription. Thanks for supporting the channel.